As we head into a new trading week, the goal is not to predict the market, but to understand the structure it is building. This weekly outlook will help you align with probabilities, key zones, and psychology, so you react calmly instead of emotionally. The past week in global markets can best be described as controlled optimism. In the United States, equity markets remained resilient. Despite mixed economic data, stocks held firm as bond yields cooled slightly and expectations around future interest rate actions became more balanced. Growth and technology stocks attracted selective buying, while defensives underperformed, a classic sign that investors are cautiously willing to take risk, but not blindly. Europe painted a mixed picture. Economic growth concerns continue to linger, keeping a lid on aggressive upside. However, the absence of fresh negative shocks prevented sharp sell-offs. Investors there are clearly selective, preferring companies with pricing power, strong balance sheets, and earnings visibility. Asian markets were largely range-bound. Some markets benefited from stable commodities and currency movements, while others remained under pressure due to weak domestic demand and lingering China-related uncertainty. Overall, Asia lacked a strong directional cue, reinforcing the idea that global markets are waiting for clarity rather than chasing momentum. For India, this global setup is important. It tells us we are not in a panic phase, nor in a euphoric global bull run. We are in a transition zone, where capital is available, but discipline is mandatory. Dollar index, bond yields and VIX impact. Three silent forces guide capital flows every week: the dollar, bond yields, and volatility. The dollar index softened modestly during the week. This matters because a weaker or stable dollar reduces pressure on emerging market currencies and improves foreign investors' effective returns when investing in Indian equities. It also supports export-oriented sectors by improving margin visibility. Global bond yields, particularly long-term US yields, stabilized rather than rising aggressively. This is a critical relief for equity markets. Rising yields compress valuations and attract capital away from stocks. Stability, on the other hand, gives equities room to consolidate and build. Volatility indicators remained contained. This suggests markets are alert, not fearful. Investors are prepared for surprises, but they are not pricing in disorder or stress. When these three variables align, stable dollar, steady yields, controlled volatility, markets typically enter a range-building or accumulation phase. That is exactly the environment India is operating in right now. Crude oil and gold weekly influence. Crude oil remains one of the most important macro variables for India. Last week, crude traded in a stable to mildly soft range. For India, this is a net positive. Stable crude reduces imported inflation risk, improves cost structures for multiple industries, and eases pressure on the trade balance. It also gives policymakers more flexibility and reduces the urgency for restrictive measures. Gold, meanwhile, stayed firm. This reflects global investors maintaining portfolio protection rather than signaling fear. In transitional market phases, gold strength alongside equity stability is normal and healthy. As long as crude does not spike sharply and gold does not surge aggressively, Indian equities can continue consolidating with a constructive bias. Nifty weekly analysis long-term zones and weekly levels. Now let's focus on Nifty, the backbone of Indian equity sentiment. Nifty closed the week consolidating around the 26,200 region. This is significant. The index is neither breaking down nor accelerating uncontrollably. It is absorbing gains and building structure. On the weekly chart, this type of candle behavior indicates institutional digestion, not distribution. Long-term structural zone. The most important long-term demand zone lies between 25,600 and 25,800. As long as Nifty remains above this band on a weekly closing basis, the broader trend remains intact. Weekly support and resistance. Support, 25,900, then 25,600. Resistance, 26,450, followed by 26,900 to 27,200. Market interpretation. Above 25,900 constructive bias, dips can be evaluated. Below 25,600 defensive posture required. This structure suggests patience is more valuable than aggression. BankNifty weekly analysis long-term zones and weekly levels. BankNifty continues to be the engine of market movement. Its structure remains positive but highly sensitive. Structural support. 58,200 to 58,600. Weekly actionable levels. Support, 59,000, then 58,500. Resistance, 60,200, then 61,500. As long as BankNifty holds above 59,000, weakness is likely to attract buying interest. A decisive move below 58,500 would change short-term sentiment and increase volatility. BankNifty is not in breakout mode, it is in controlled leadership mode, which favors disciplined setups rather than leverage. Sector rotation: leaders versus laggards. Sector behavior last week gave a very clear message. Leaders: private banks and financials. Capital goods and industrials. Select large-cap defensives. These sectors benefit from yield stability, policy continuity, and institutional preference for balance sheet strength. Laggards. Metals and commodity-linked stocks. Overheated mid-caps. High beta small caps. This divergence tells us something crucial. This is a quality-driven market, not a momentum-chasing market. When markets reward stability over speculation, risk management becomes more important than return maximization. FII DII weekly activity, cash plus derivatives. Foreign institutional investors remained cautious but not aggressively bearish. This indicates hesitation, not fear. Domestic institutional investors continued selective accumulation, especially in large cap and index-heavy names. This behavior creates a base for the market and reduces downside risk. In the derivatives segment, positioning suggests index spinning near key levels. This often leads to choppy intraday moves that punish emotional traders and reward disciplined ones. Overall, institutional activity supports consolidation, not breakdown. Key events for the coming week. Several triggers can influence markets next week. Global inflation and growth data. Bond yield movements. Dollar strength or weakness. Crude oil behavior. Major corporate earnings. RBI liquidity signals. Any surprise here can shift sentiment quickly, especially in a consolidation phase. Market psychology expected behavior this week. This is not a fear market. This is not a euphoria market. This is a discipline market. Expected behavior. Dips bought near strong supports. Breakouts tested, not chased. Fast punishment for emotional trades. Preference for quality over speculation. Markets in this phase reward patience, preparation, and risk control. Watchlist. Large private bank. Why? Credit growth visibility, yield stability, index leadership. Export-focused IT major. Why? Dollar stability, margin visibility, global exposure. Downstream energy refining name. Why? Crude stability supports margin outlook. Quality industrial midcap. Why? Capex cycle, order book strength, but position size is key. Educational reminder, indices lead stocks. Always align stock trades with index structure. To summarize. Global cues are supportive but fragile. India is consolidating at higher levels. Structure remains bullish above key supports. Sector rotation favors quality. Discipline matters more than direction. If you trade with structure, the market gives opportunity. If you trade with emotion, the market takes capital. That's your weekly outlook. We reassess again next Sunday.